Has this 2-week pullback and rotation away from tech reset valuations and expectations enough to refresh the rally? Or will the water stay too choppy for comfort into the heart of earnings season and next week's Fed meeting? Here to weigh in on all that is Avery Sheffield, VantageRock co-founder and CIO. Avery, good to see you.
Great to be here.
So this is the job of a pullback, right? To test some assumptions about the fundamentals, to see if it was all just noise and excess optimism and positioning. Where do you think the market sits right now in a big picture way?
Yeah, in a big picture way, I think the market is still overall quite expensive, and there's a lot of vulnerability to many of the more expensive names in the market. So, but at the same time, I do think that some of the move up in some more reasonably valued names that have been really overlooked probably make sense and will stick, yet other moves up in more junky names probably will come home to roost over the months ahead.
So reasonably valued, I guess, assuming that earnings remain on track, that the economy can hang in here. I mean, the soft landing view seems to underpin most of what we can hope to expect from these companies.
Yes. I mean, certainly there's a risk to the downside. We had Bill Dudley out, saying, hey, we've got to cut immediately. Yeah. Like, we're starting to see data roll over. We're close to the Somme rule, in unemployment. So there are risks, but what we've seen is that this economy is so sensitive to interest rates. I think the moment the Fed cuts, as the market starts to digest Fed cuts and brings rates down before the Fed actually does, that has a stimulative effect, right? We saw core services spending ex housing right as rates came down in November immediately start to spike up from about 2% to 5% on a 3 months annualized basis. Then it came down as rates came back up again. So we do have so much sensitivity to interest rates that I think that we probably don't have to worry about the economy falling apart. By the way, if the economy fell apart, a lot of stocks would have to go a lot lower. Oh, yeah. So, but my view is the Fed doesn't want to re-stimulate the economy. They don't want to re-stimulate inflation. They want to have a more even keel. And many stocks are not priced for that even keel. There are still stocks that are underpriced for it, and other stocks that are quite overpriced for it.
It seems that's the result of this environment we had for a while where you had sort of a scarcity of predictable earnings growth, or at least above trend earnings growth in those big mega cap secular growth names. Plus you had the AI story that was just kind of rampaging through tech. And all of that got you this concentrated market. Everybody would have agreed we probably need to rebalance the market. It would be a lot to expect for it to happen painlessly or quietly. So it hasn't been. There's been some friction along the way. But you seem to think that the big stuff still is a little bit too expensive or too aggressively owned?
I think vulnerable.
Yeah.
Vulnerable. Because these companies have... The valuations are high, not extremely high for some of them on earnings, but on free cash flow, all of them are getting stretched because they're spending so much on CapEx, right? A lot of that's on AI. In some cases, in some of the cases, it's on infrastructure. But we really need to see a return on investment of that CapEx. If we don't see a return on investment, there were questions on a recent mega cap conference call. Are we potentially overspending, going to go into excess capacity related to AI and cloud? Those questions weren't being brought up before. The answer was, we need to spend. That's more important to spend than to not spend, right? We've got to be ahead of this. But now that investors are starting to ask for answers, I think these companies are going to be very vulnerable if they're not able to demonstrate an ROI or a kind of not necessarily a negative growth, but a pullback in the acceleration of growth. If they're not focused on efficiencies, I think they're very vulnerable here. But if the CEOs express, hey, we've spent a lot and we're going to digest and move forward, yeah, I think actually the stocks could do well. But it's in a much trickier place than it was before, where investors would just buy the dream.
Yes.